Welcome to the Techno Fundamental Report for November the 2nd. You know, when you think about strategy and you notice like here we have a football game going on, the coaches have to make all these statistical decisions. Should we be more offensive? Should we be more defensive? It's like a battle, and you're fighting it out on the field, and these guys are pretty much calling the shots. So you have to kind of pay attention to statistics and patterns. Now, what is good for General Motors is good for America. That was an old-time saying. But I wanted to point out, you know, after the UAW strike and so forth, General Motors' stock has really come down quite a bit. Same for Ford. But the point I'm really wanting to make as we get into a little bit of understanding trends, you can see here that you had a rally in the stock where there was a tremendous amount of buying that pulled the stock up. Now, the problem you have here with this type of pattern is that you have something called overhead supply. So be aware of overhead supply of sellers, because this pattern here was identified by William O'Neill in his 100-year study, and it was the most common pattern that he would see at a market bottom and then the beginning of a new uptrend. And it's called a cup with a handle. It resembles a teacup viewed from the side. So here you have the rally, then you have the sell-off. You have some sellers coming in here. Now, you don't want the sellers to totally dominate the situation. So as you see, as the pattern unfolds, you have the overhead supply, but it gets worked off because the stock starts to recover, then you get the handle, and then you get the breakout. So what I'm really trying to convey is that over time, as you work with charts, you develop what you call a chart eye. If you read O'Neill's book, and you may want to pause your video player, because here's where he describes the cup and handle pattern that was really is important to understand. And you may want to take a look at the book and read this section here, because it gives you the specific criteria. Now, breadth indicators, let's get into the market here for a minute. Breadth indicators are basically, is the market broadening out or is the market very narrow? And right now it's very narrow. So some of the indicators that make sense would be the small cap advanced decline line. And you can see here that the small caps, there's more decliners than advancers. So as the indexes, and as I repeat, we use 5 indexes because these 5 indexes help you with identifying breadth. Where is the market broadening out or is the market narrowing? Now, this is the percent of stocks above their 200-day moving average. As you can see, below 50%. So, you know, over roughly 75% of the stocks on the New York Stock Exchange are below their 200-day moving average, which means they're in a downtrend. So we need the market to broaden out, is my point. And we'll look at some other stuff here. No formula in finance tells you that the moat is 28 feet wide and 16 feet deep. That's what drives the academics crazy. They can compute standard deviations and betas, but they can't understand moats. Really important, the study that was done by J.P. Morgan that I've shown in the past of the top performers, and then they also disclosed why the underperformers failed. And most of the time it's primarily because of competition. So you want a wide moat and a deep moat around your company. Now, back to interest rates here. You can see here that the power index is hitting a new high here. However, it does look like interest rates are trying to work their way down. So as interest rates stabilize and as we go through time, this particular indicator will go into a downtrend and then go to zero, which is our objective, because we want to see where the free market is saying that interest rates are starting to stabilize and possibly even turn down. Now, the aggression index, I wanted to point out the aggression index has been pulling back. However, we've been having a little bit of a rally in here. It's below the upper moving average, but it's basically saying kind of don't be too aggressive here, but keep your watch list going. Our 3 economic indicators, you can see here where the 10-year Treasury is kind of working its way down a little bit here. Price of oil is starting to pull back, still holding above the 200-day, but appears to be in a downtrend. The financial stocks, we did get a little bit of a pop in here. Again, we've got to see more strength in the financials. Now, I wanted to point out Apple. This is another really kind of an example of overhead supply. The stock, this chart just does not look good. And, you know, Apple reports earnings tonight. Be very interested to see how that works out. But so far, Apple appears to be in a downtrend, which is a somewhat of a bellwether for the rest of the market. We would really like to see Apple stabilize, you know, give that bottom of a cup and get a handle going and get going this way. We'll have to see how the earnings look tonight. This is that Renaissance Fund. This is all the stocks that have gone public in the last couple of years. You can continue to see a downtrend here, but hopefully starting to base and build a base as we look at it. Regional banks, the regional banks continue to be weak. You know, we broke down, made fresh low, broke down, made a fresh low. However, just like Apple and the IPO fund, we're starting to see a little bit of stabilization in there. The semiconductors, very important group. Again, we're seeing highs, lower highs, lower highs, lower lows, and lower lows. So this is the semiconductors have been in a downtrend. However, yesterday we got somewhat of a nice pop in that group. Now, I did want to point out the NASDAQ. The NASDAQ continues to be in a downtrend, broke below the 200-day moving average, however, has popped back above it. We're not seeing volume like we would like to see. On this rally that we had, it was on lower volume than the prior day. We would like to see volume on the upside pick up somewhat. Now, the S&P, same thing. We're continuing to see lower highs, lower lows in a downtrend and below the 200-day moving average, however, starting to show signs of improvement. So bottom line is keep your powder dry. Don't be too aggressive here. However, we could be starting to see the signs of maybe a year-end rally. We'll just have to see. But so far, breadth is negative. It's not positive. We need to see the market broaden out. If you have any questions, please let me know.